If you are coming across my channel for the first time, I say you are welcome. And if you have been with me in this channel from the past, I say thank you and God bless you. In this lecture, I'll be examining single limiting factor and throughput accounting. Limiting factor or factors and throughput accounting. I will explain the various concepts underlying the two topics. I will equally solve questions from ICAN November 2023 Performance Management. Question number 4 as work example. So what do you mean by limiting factor? Limiting factor are the items that restrict the production or sale of product or services. Items that restrict, that hinders, that reduce the production or sales of items or services. Items that reduce the production or sales of products or services, that is limiting factors. What are the steps or the procedures for solving questions involving single limiting factor? The first step is steps. Number 1, determine the unit contribution. That is the contribution margin for each of the products, margin for each of the products. That is the first step. The first step is to determine the contribution margin for each of the products. What do you mean by contribution? Contribution margin, that is selling price minus unit variable cost. So when you deduct your variable cost from selling price, you arrive at the contribution margin. That is the first step. Step 2, identify the limiting factor. The limiting factor. To identify the limiting factor, you have demand, you have limiting factor or key resources, the product. If this is A and this is B, A times B. So you have, if demand for this is X and this is A, X times A will give you XA. If this is Y and this is B, Y times B will be YB. So when you add this and this, XA plus YB, that will be the required. That is required, the amount required. Then the available will be given in the question. Available. So let's assume it is ABC. So it is possible this available, it may be less than this, than the required, or greater than the required. Where this is greater than the required, that means that resources is not the limiting factor. But where the required is greater than the available, the difference will be the shortfall. So that shortfall will be, that means where this is greater than this, that means that resources is not enough, so it is the limiting factor. So in that case, that is the second step. You identify the limiting factor. Step 3, calculate contribution per unit of the limiting factor. Calculate contribution per unit of limiting factor. Step 4. Rank the contribution per unit of the limiting factor in descending order, that is from the highest to the lowest. So you rank it. The step 5. Consider whether the organization is trying to give priority to any of the products. Consider whether they are trying to give priority, preferential treatment to any of the products, and this has to be considered in your calculation. Step 6. Prepare the allocation table. Just product mix. So your hours, or let me say key resources, or limiting factor, key resources, or your limiting factor. So based on your ranking, the one that takes the first position will be considered first. So you have the available key resources. It may be materials, it may be labor, it could be anything. So you consider that available. Then the one that is ranked first to, if A is ranked first to A, then you have the mix of A that will be produced. The balance after A. The one that is ranked second to, let's say, product C. So you consider that product mix. The balance after C. Then the one that is ranked third, maybe you have 3 products, product B. So the remaining balance will be allocated to that product. Then you will now be left with nil balance. So the product mix now will be what you have here divided by time, that is divided by your key resources. So that will give you the mix of that product that can be produced. That is product mix. So this is the steps you need to follow. These are the steps you need to follow when solving questions involving single limiting factor. Now I want to consider throughput accounting. Throughput accounting is a system of performance measurement and costing which traces cost to throughput time. Throughput accounting is a system of performance measurement and costing which traces cost to throughput time. It aims at complementing JIT, just-in-time system. The aim of throughput accounting is to complement just-in-time system. So our focus in this topic is the calculation of throughput accounting ratio. Throughput accounting ratio. To calculate throughput accounting ratios, you need 2 variables. You need 2 variables to compute throughput accounting ratios. Number 1 is return per factory hours, return per factory hours, or factory minutes. and cost per factory hours or minute. These are the two variables you need to compute throughput accounting ratio. And to compute the return per factory minute, we equally need two variables. Your throughput contribution. Remember, throughput contribution is sales price less material cost. Since only material is considered variable under throughput, that is why we have sales price less material cost. Then the second one is, I said you need two variables to compute return per factory hours. The second one is time on key resources. So throughput contribution over time on key resources. And to also compute cost per factory hours, you equally need two variables. Total factory cost, TFC, total factory cost. I want you to know that in throughput accounting, all cost is assumed to be fixed in short run, except material cost. Meaning that only material cost is variable. Aside the material cost, all other costs are fixed in the short run. So you are going to sum up all the fixed costs. You add up all the fixed costs. That is every other cost you have in question. You add them up, except the material cost. You add all every other cost together. That will give you the total factory cost. Then you also need total time available on key resources. Total time available on key resources. So what is the difference between this and this? This one is time for a unit, time per unit. This one is total. Take note. This one per unit. So, and that will be provided in the question. So, these are the variables required to compute your throughput accounting ratio. Therefore, what is throughput accounting ratio? Throughput accounting ratio. Throughput accounting ratio. Throughput accounting ratio is equals to return per factory hours or minute. Return per factory hour or minute over cost per factory hour or minute. Cost per factory hour or minute. That is throughput accounting ratio, number one. Then I've told you that to compute the throughput accounting ratio, you will need two variables. Return per factory hours. I said you equally need two variables to compute return per factory hours. So return per factory hour or minute. Return per factory minute. So it may be provided in minutes. So it depends on the question. That will be throughput contribution, which is sales price minus material cost. I've told you that only material cost is variable in throughput over time over, we've considered it, sales price less material cost over time on key resources. Time on key resources. That is return per factory hour. Number 3, you equally need cost per factory hour. Cost per factory hour or cost per factory minute. So I said that is equals to total factory cost. Total factory cost. TFC, total factory cost, over total time available on key resources. Total time available on key resources. So these are the formula required in throughput accounting. But I want you to know that when you compute your throughput accounting ratio, it must be greater than or equals to 1. Where your throughput accounting ratio is less than 1, that means the product will be loss making. It will be a loss making product. Throughput accounting ratio should be greater than 1. Where it is less than 1, I said it should be a loss making product. The company should consider withdrawing that product from the market. Where the throughput accounting ratio is less than 1, the company should consider withdrawing that product from the market. So you are expecting your throughput accounting ratio to be greater than or equals to 1. So the product will break even if your throughput accounting ratio is exactly equal to 1. Where it is greater than 1 to be making a product. That means you are expecting your throughput accounting ratio to be greater than 1 if you are expecting a profit. So where it is exactly equal to 1, the product will break even, and where it is less than 1, the product will be a loss-making one. So now these are the steps and the formula required in solving problems involving a single limiting factor. I therefore want to consider a work example from ICAN November 2023 Performance Management question number 4. Please stay tuned and don't forget to like this video, share it and subscribe so that the video will be able to go viral and reach other people who will be in need of it. Thanks. Now, example. This question is obtained from ICAN November 2023 Performance Management. PK Limited manufactures 2 models of heavy-duty cooking rack suitable for use in restaurants, kitchen, and similar commercial environments. Both models use the same type of raw material and machine hour. No inventories ahead. The sales budget for next year is as follows. We have Model A and Model B. Sales in units, 300,000 for Model A and 140,000 for Model B. Selling prices, 1,000 naira for Model A and 1,400 naira for Model B. The following additional information is provided. Cost data, we have Model A and Model B respectively. Material cost, 400 naira and 500 naira. Variable production conversion cost, 100 naira and 300 naira for Model A and B respectively. Fixed production overheads attributable to the manufacture of the 2 models amounted to 40,500,000 naira. Each model is completed in the machining department. The production rate per hour in the department is Model A 12.5 units, Model B 10 units. Availability of machine hour is limited to 30,000 hours required. A. Using marginal costing principles, calculate the mix in units of each model which will maximize net profit and indicate the value of the net profit. B. Calculate the throughput accounting ratio for each of the 2 models and briefly discuss when it is worth producing a product where throughput accounting principles are in operation. Your answer should assume that the variable overhead cost amounting to 24 million naira incurred as a result of the choosing product mix in part A is fixed in the short term. C. Using throughput accounting principles, advise management of the quantities of each model that should be manufactured, which will maximize profit, and prepare a projection of the net profit that will be earned by PK Limited next year. D. Explain two aspects in which the concept of contribution in throughput accounting differs from its use in marginal costing. This is the question. ICAN November 2023, question number 2. Solution. Let's have the solution. Solution. Now, this is a question involving single limiting factor. The name of the entity is PK Limited. Single limiting factor and throughput accounting. Now, I've told you that to solve questions involving single limiting factor, the first thing is to identify the limiting factor. You are given the availability of machine hours to be 30,000 hours. You want to confirm the adequacy of this machine hours. Is this machine hours sufficient for the production of 300,000 units of model A and 140,000 units of model B? Since 300,000 and 140,000 are the number of units of model A and B demanded, respectively. So we want to know if the 30,000 hours will be adequate. Now, you were told each model is completed in the machining department. The production rate per hour, since it is completed in machining department, that is the machine hour. The production rate per hour in the department is 12.5. This is the rate per hour. If this is the rate per hour, you need the rate per unit. Since you have been told that to produce 12.5 units, it will take you 1 hour for model A. How many hours will it take to produce 1 unit? So you need the standard time per unit. You want to convert it to 1, you have to convert this one to 1. How many hours will it take to produce 1 unit? So you divide this by 12.5. 12.5. So this will give you the standard time per unit, which is 1 over 12.5. So you need the standard time per unit. Standard time per unit. For model A. Model A. So we have 1 over 12.5. 1 divided by 12.5. That gives us 0.08 hours per unit. So for model B, 1 over 10, which will be 0.1 hour per unit. So this is the standard time per unit, since you have been given 12.5 for model A and 10 units for model B. Now, you want to confirm the adequacy of the limiting factor. Confirmation of the adequacy of 30,000 machine hours. You want to know if this 30,000 machine hours, if it will be adequate. Now, model A and model B. Now, The number of units demanded for model A is 300,000. 300,000 units. 300,000 times what is the how many hour is required to produce one unit? 0.08 times 0.08. 30,000 times 0.08. I mean 300,000. We have 24,000 hours. So that gives us 24,000 hours. To achieve the 300,000 units of production for model A, you will need 24,000 hours. For model B, demand for model B is 140,000 units. 140,000 times, to produce one unit, you need 0.1 hour. 140,000 times 0.1, that gives us 14,000 hours. That is, to achieve 140,000 units of model B, you will need 14,000 hours. Total machine hours required to produce 300,000 units of model A and 140,000 units of model B. You will need the total of 38,000 machine hours. 24,000 plus 14,000, that is 38,000 machine hours. Then available machine hours. The available machine hours is 30,000 hours. 30,000 hours. Since 30,000 is available and 38,000 hours is required, that means the available machine hour will not be sufficient to produce 300,000 units of model A and 140,000 units of model B. So there is a shortfall of 8,000 machine hours. So a shortfall. Therefore, machine hours is the limiting factor. Then the next step is to compute the unit contribution, the contribution margin for each of the products. We want to determine the unit contribution. So we have, remember, contribution is selling price less variable cost. Selling price less variable cost. That is contribution margin. So now, step 2. The calculation of unit contribution. That is calculation of contribution margin. We have model B. We have model A. Remember, contribution is selling price less variable cost. And the selling price for model A is 1,000. Selling price $1,000. And that of model B is 1,400. Remember, the unit demanded is 300,000 and 140,000. I want to rub it off. It will be used later on, so that you will not be wondering how I got 300,000 and 140,000 as the quantity. So when we are using it later. So contribution, selling price less unit variable cost. Our variable cost comprises material cost. We have material cost. For model A, we have 400. For model B, we have 500. Then we have variable production conversion cost. Variable production cost. For model A, we have 100, and model B, we have 300. 100 and 300. The next one is fixed cost. Now, if you deduct this, you have contribution margin. Contribution margin. Our contribution margin, 1,000 minus 500. This will be 500. this plus this is 800. If you subtract it from 14, you'll be left with 600. That is the contribution margin. Then machine hours, the next step, step 3, is to calculate contribution per machine hour. So the machine hours, the standard time as determined earlier, we have 0.08 for model A and 0.1 for model B. 0. Step 3 is to determine the contribution per machine hours. And the standard time per hour is 0.08 for model A and 0.1 for model B. So we have 0.08 and 0.10. Therefore, contribution per machine hour. Contribution per machine hour. We have 500 divided by 0.08. That gives us 6,250. 6,250 for model A. 600 divided by 0.1. That gives us 6,000 naira for model B. The next step is to rank it. Let's have ranking. The one that will be ranked first, this is the highest. First and then second. Then the next step is the priority allocation. Now let's have the allocation table. Allocation. Now let's have the priority allocation. Allocation table. Let's have demand or product mix. Product mix. Available machine hour. Available machine hours is 30,000 hours. So let me have ranking here. The product that is ranked first is model A. Model A is ranked first. Now, the demand for model A is 300,000. And machine hours required per unit of model A is 0.08. So that gives us 24,000. 24,000 hours will be allocated to model A. That means we still have sufficient hours to produce the whole 300,000 units of model A. So you can produce 300,000. Then the balance. How many machine hours are you left with? 30,000 minus 24,000, you'll be left with 6,000. You are left with 6,000 machine hours. That 6,000 machine hours will be given to model B. Model B. So you give 6,000 hours to model B. If you give 6,000 hours to model B, that means you'll be left with need balance. How many units with this 6,000 hours, 6,000 machine hours be sufficient to produce? Remember, to produce a unit of model B, you will need 0.1 machine hours. So that means you have 6,000 divided by 0.1. So 6,000 divided by 0.1, that will give us 60,000 units. That means 60,000 units of model B will be produced. Therefore, optimal production plan will be model A 300,000 units. Model B, 60,000 units. Now, back to the requirement. Using the marginal costing principles, calculate the mix in units of each model which will maximize net profit. That is the units, the mix of each model. That is the answer. Which will maximize net profit. And indicate the value of the net profit. So the next thing is to calculate the value of the net profit. I have the profit statement. So you want to determine the value of the net profit. So you have contribution. For model A, the contribution margin has been calculated earlier. And we got contribution of 500 and 600. 500 times how many units of model A? 300,000 units. 500 times 300,000. That gives us 1.123 5 6 7 2 3 5 6 150 million. 150 million. Let me keep 3 zeros. Then we have model B. We have 600 times the number of units is 60,000. 600 times 60,000. That gives us 36 million. So when you sum it up, we have 158 million. That is the total contribution. Total contribution from the two models. Then you now less fixed cost. The fixed cost, you were told fixed production overheads attributable to the manufacture of the two models amounts to 40.5 million. Our fixed cost is 40 million 500,000. If you deduct the fixed cost, then you'll be left with 117,500,000. That is the net profit. That is the solution to the requirement A. Now, in requirement B, you are to calculate the throughput accounting ratios for each of the two models and briefly discuss when it is worth producing a product where throughput accounting principles are in operation. Your answer should assume that the variable overhead cost amounting to 24 million incurred as a result of the choosing product means in part A is fixed in the short term. Remember, in throughput accounting, the only variable cost is material. All other costs are fixed. And you have been given the variable cost, you have been told it is fixed. And you were told it's 24 million. So it is a fixed cost. The only variable cost is material. Now, let's calculate the throughput contribution. We have selling price. For model A, we have 1,000. Model B, 1,400. We said in throughput accounting, we said only variable cost is material. Only material is variable. So we have material cost. For model A, we have 400. and 500 for model B. If you subtract that, you have return, throughput return, throughput return or throughput contribution. So this is 600 and this is 900. Then time on key resource. This has been determined earlier. For model A we have 0.08 and for model B we have 0.1. So return per factory hour now. Return per factory hour. For model A, we have 600 divided by 0.08. That gives us 7,500 naira. For model B, we have 900 divided by 0.1. That gives us 9,000 naira. That is the return per factory hour. So we've done with the numerator. The next thing is the denominator. Cost per factory hour. Cost per factory hour. So, cost per factory hour equals to total factory cost I've told you that our total factory cost will be the sum of all the fixed costs. I've told you that the only variable cost in throughput accounting is material. So over total time available on key resources. Over total time available on key resources. Total time available on key resources. That will give us the return, cost per factory hour. So what is now the total factory cost? Total factory cost. Total factory cost comprises, we have fixed production overheads attributable to the manufacture of the two models amounts to 40.5 million. Fixed production overheads 40,500,000. Then variable overhead cost amounting to 24 million incurred as a result of the choosing product mix in part A is fixed in short term. Variable overheads cost, and that amounted to 24 million. You should sum up that. We have 64.5 million naira. That is the total factory cost. So cost per factory hour now. Cost per factory hour, which is the total factory cost, which is 64.5 million, over total time available on key resources. The available hours, which have been given earlier, is total 30,000 hours. So if you divide that by 64.5 million divided by 30,000, that gives us 2,150. Therefore, cost per factory hour, that amounted to 2,150 naira. 2,150 naira. So in requirement B, you have to calculate the throughput accounting ratio. So throughput accounting ratio now. Throughput accounting ratio. I've told you that throughput accounting ratio. I said it is equal to return per factory hour or minute over cost per factory hour or minute. Throughput accounting ratio. Let's have for model A. Return per factory hour for model A. Return per factory hour, that is 7,500 over cost per factory hour, which is 2,150. 7,500 divided by 2,150. So we have 3.49. 3.49. Model B. Model B. Return per factory hour, that is 9,000 over cost per factory hour, 2,150. 9,000 divided by 2,150. So we have 4.19. 4.19. That is the throughput accounting ratio. Now, C. Using throughput accounting principles, advise management on the quantities of each model that should be manufactured, which will maximize profit, and prepare a projection of the net profit that will be earned by PK Limited next year. So if you have to choose based on the basis of the throughput accounting ratio, model B has the highest throughput accounting ratio. So that means you are going to favor model B. Or if you rank it based on return per factory hour. So now let's rank this now. Ranking. Model B will take first position and model B will take second. Now let's have our priority allocation now. Priority allocation or allocation table. Product mix now. Available machine hour. Is 30,000. 30,000 machine hour. That is the time on key resources. Now, on the basis of our ranking, our first position is product B. To B now. To model B. To model B. So, model B. The demand for model B. Demand is 140,000. So we have 140,000 times time on key resources is 0.1. So that will give us 14,000. So that means you still have sufficient hour to produce model B. So you are going to produce 140,000 units of model B. So now, if you remove 40,000 from 30,000, you'll be left with 16,000 machine hours. That is the balance left after you have allocated to model B. This balance now will be allocated to model A. Model A. So, model A now, the demand is 300,000, but you are only left with 16,000 machine hours, which will be allocated to model A. Balance will now be nil. Balance nil. So if you allocate these 16,000 hours to model A and it takes 0.0 hours to produce a unit of model A, how many units will you produce with this 16,000? So we have 16,000 divided by 0.08. 200,000 units. 200,000 units. That means you can only produce 200,000 units of model A. Now back to the requirement C. Using throughput accounting principles, advise management of the quantities of each model that should be manufactured, which will maximize profit, and prepare a projection of the net profit that will be earned by PK Limited next year. So, the units to manufacture to maximize profit will be 200 units of model A and 140,000 units, 200,000 units of model A and 140,000 units of model B. Now, so PK Limited profit statement. We have throughput contribution or throughput returns. Model A, if 200,000 units will be produced, we have 200,000 units times 900. That gives us 180 million. 180 million. Model B, you will produce 140,000 units of model B and the returns is 600. 140,000 times 600. That gives us 84 million. So plus 180 million. That is total 264 million. Then you now less fixed cost, our factory cost, which comprises, okay, we've totaled our factory cost earlier, and our factory cost was totaled. The variable of 24 million plus fees of 40.5 million. We have 64.5 million. That is the total factory cost. 64.5 million. If you now deduct that from 264 million, so you have 199 million 500. That is the net profit. That is the answer to requirement C. Then D. Explain two aspects in which the concept of contribution in throughput accounting differs from its use in marginal costing. If you look at our marginal costing, so all variable costs were deducted in arriving at contribution. That means our contribution, we have sales less direct materials, direct labor, and variable overheads. But in throughput, only direct materials was considered as a variable cost. Only direct material was considered as variable. That means to calculate contribution in throughput accounting, we only have sales price less material cost. But under marginal costing, you'll be having sales price less direct material cost, less direct labor, less variable overheads. That means the direct labor which were subtracted and the variable overheads which were subtracted in getting the contribution under marginal costing, they were excluded from the calculation of throughput returns. So that is just the major difference between the marginal costing and the throughput accounting. This is the end of this lecture. In my next class, I will consider the special case of single limiting factor, special cases. So where we are not going to follow our normal rules. No, I've given you the rules. So the rules I have given in this question where it will not work. So where you are going to follow another principle. That is what I call special case or single limiting factor. Please don't forget to like this video, share it, comment in the video, and subscribe. Thanks for watching.